Welcome to today's live event. I am Andrew Wilkinson at Interactive Brokers up here in Greenwich, Connecticut. I'm actually not in the office today, but I've put a tie on for the occasion. Got a brand new guest today. Vincent Randazzo is a CMT, and he is the founder of ViewRight Advisors. Vincent, welcome.
Thank you, Andrew. Appreciate being here.
Tell us a little bit about ViewRight Advisors, because you're not actually an advisor in the true sense that you manage money, right?
That's right. That's right. So we actually advise advisors, if that makes sense. And we have a proprietary service which gauges market health and lets advisors know when to, let's say, dial up and dial down equity market risk at any given time, according to our proprietary process.
Very good. Now, today's chosen subject is about market breadth, which is, I mean, I'm a big fan of technical analysis, but I never learned much about market breadth. So when a technical analyst starts going off about, oh, market breadth is doing this, doing that, that's kind of my Achilles heel. Tell us a little bit about what we're going to learn today.
Yeah, no, it's great. I'm glad you said that, and I know you're a huge proponent of what we do in terms of the technical analysis world. And I think that's great. You know, demonstrates open-mindedness and listen, as many tools as we can bring to the table to do what we need to do, right? And I think breadth is one of those that's been really, I would say, misconceived, misunderstood, even the way it's framed in financial media by people who should know better, let's say. It sort of misses the point, I think, in a lot of ways. So I'm going to try to bring it from a really basic level all the way down to sort of where the rubber meets the road and how do you implement something like this in your own analysis of the markets and how you would sort of manage portfolios.
All right, excellent. Looking forward to getting into the deck here. Vince, if you wouldn't mind putting up slide 2 so the audience can read the disclaimers and disclosures from Interactive Brokers that we're always required to show. This is a live event, so please do use the opportunity to ask Vince questions here, enter them into the chat panel, and we'll do a Q&A towards the end. If you want to download the presentation deck, please expand the handouts panel and click on the link to access the PDF and download it. And you will receive an email in a couple of hours after we finish speaking this afternoon with a link to the recording. And you can see any of our webinars, previously recorded webinars, at the Interactive Brokers campus. Just look under education from the main ibkr.com website. With that, I'm going to toss this back to Vincent. Off you go, mate.
All right. Well, thank you, Andrew, and welcome everyone. And thank you for joining today's Interactive Brokers webinar, Beyond the Index, Using Market Breadth to Spot Hidden Vulnerability. I'm Vincent Randazzo, of course, the founder of ViewRight Advisors and the former head of technical research at CFRA, otherwise known as Lowry Research, which some of you may be familiar with. Today, we're going to start by tackling a question every investor faces at its core, right? Is the market as strong as the index suggests, or is something happening beneath the surface that I need to be aware about, right? And then we'll go a little deeper from there, no pun intended, and we will we'll apply this again in a way that can move into everyone's portfolio and the way they think about markets. So I'm just going to start real quick with a little bit more about me, my quick background, how this came together. So I launched ViewRight Advisors in January of this year with a very specific goal, and that is to make long-term equity risk management systematic, disciplined, and easy to follow. So in other words, to get the market view right, which is one of the reasons why I named the company what I did. So the mandate was twofold. And number one is to stay invested as much as possible because markets are higher roughly 75% of the time on an annual basis. But to also, number two, avoid the deep or prolonged drawdowns that do most of the long-term damage. Market breadth is, for me, what sits at the center of that balance, right? I started my career in 2002 in equity research sales at Morgan Stanley, which unfortunately or fortunately meant that I learned risk management the hard way, right in the middle of a major bear market. And the decade that followed was with essentially no new highs, reinforce one lesson above all, and that's avoiding losses matters more than chasing returns. And as those equity desks shrank at that time and competition frankly intensified in New York in that job market, I leaned into technical analysis as a way to differentiate myself, learning how to integrate economics, fundamentals, and market behavior into a really coherent format. And that's what helped me stand out. Most recently, I spent 8 years at Lowry Research, where I was fortunate enough to be mentored by Paul Desmond, one of the early pioneers of modern market breadth and one of the founding fathers of the CMT Association, actually. And under his guidance, I went deep into breadth research, and that work ultimately became the driving force for the basic processes I'll be sharing with you today. So here's our roadmap. Basically, we'll start with the problem, explore the key breadth tools, connect them with investor psychology and risk management. I think that's really important. And then review the actionable framework, and then finish, of course, with historical examples of today's market snapshot, sort of where we are right now and how does this apply right now. So with that, let's dive in. So here's the key issue, right? As important as the major indexes are, they're not always reliable gauges of overall market health. Most indexes are market cap weighted. And in the case of the Dow, it's price weighted, which means that you have a relatively small group of mega cap stocks that can dominate the index and distort what the index is actually telling us. And this is important because historically, that effect becomes most pronounced right near major bull market peaks, when investors actually crowd into the largest, strongest, and perceived safest companies. The index can, of course, keep rising even as that participation underneath quietly deteriorates. And that's how you end up with this sort of illusion of strength. One thing I always thought was just so fascinating when I did a lot of the work in the last 100 years, looking at those major market tops, is this illusion of strength. At major market tops over the last 100 years, when price indexes are making their final highs, on average, only about 6% of stocks are also hitting new highs on that day. And this is even more fascinating. More than 25% of stocks are already down 20% or more. So just think about that for a minute. You have the indexes hitting new highs, but you've got a quarter of stocks that are already in, let's say, bear markets, right? Now, most investors don't realize that because it runs counter to the popular image of a major market top. People tend to picture euphoria, broad gains, everything is great, but the data beneath the surface tells a very different story. And that's exactly where market breadth becomes so valuable. I want to start with this slide on concentration. And I'd make the argument with concentration in the largest stocks at or near historic extremes right now, being able to assess true market health has become more important than ever, right? A lot of investors look at the S&P 500 and they assume broad market strength because you've got 500 of the best companies in the world, basically. But in recent years, you have a very small group of mega cap stocks that have been able to make the index appear healthy, even as at some points, participation underneath has weakened. In fact, during 2023 and 2024, a huge part of the S&P's gains came from just those top 7 stocks. Now, I don't have to go through all those stats. You probably all know them, but I think the point is that this isn't necessarily abnormal or even inherently bad, but it does matter, right? Today, the top 10 stocks account for roughly 40% of the entire index. And when leadership narrows to that degree, it becomes harder to gauge the market's true health. And if those leaders stumble, of course, they can have an outsized impact on index level performance. So that's where looking beneath the surface becomes critical. It helps us to answer that simple question: Is the market being driven by a broad army of stocks or just a few high-ranking generals, right? Strong, durable markets typically require participation across many sectors and stocks, not just the leadership at the top. And one way to visualize this or think about this is by comparing the traditional market cap weighted S&P with the equal cap weighted counterpart. When the cap weighted index continues to rise while the equal cap version lags, that signals that the gains are becoming more concentrated and that the headline index strength may still look impressive, but the internal participation is actually narrowing. And again, this isn't automatically an alarm bell. The math of index weighting is what it is, but it is something we need to be aware of when we're using index performance to infer market health or to assess how much risk we're really taking in our own portfolios. And that's why relying solely on index performance from a price basis can underestimate risk, and why incorporating breadth indicators gives us a more honest read on underlying market health. So the next section here, and because the question becomes, if index performance can mislead us, right? If price isn't truth, then how do we measure true market health? And the answer, of course, is breadth. So what is breadth exactly? And why does it matter? Now, there's a lot of misconceptions around breadth, how it's used, and you'll hear one phrase literally all the time on financial TV, and it really drives me nuts. They say leadership is narrow. Well, I would argue, of course it is. By definition, leadership, if you take the definition of that word, at any time is always narrow. Think about it. On any team, there are only a couple of true standouts or leaders or a team captain. That's what makes them leaders. So when leadership and breadth get conflated, it tends to create more confusion than clarity. A more accurate warning statement would be that leadership is strong, but stock participation in the overall advance is narrow, right? And that's what breadth is. At its core, it simply is a measure of participation. It looks at how many stocks are advancing versus how many stocks are declining, how many stocks are trading above key moving averages, at new highs, at new lows, etc. Using this same methodology, breadth answers a different question. Are the soldiers actually following the general, right? And where participation is broad, that tends to be not only more powerful, but you have more durable advances, advances that tend to last for much longer. The greater the number of stocks moving higher together, the harder it is going to be to stop and reverse that collective advance. And at the same time, the same principle really would apply to the downside. And don't get me wrong when I say this, price absolutely matters, but it doesn't tell the full story, certainly not on an index level. And that's because when you look at breadth gives every stock an equal vote, regardless of the size. So it reveals something that price alone cannot, and that is investor risk appetite and the expansiveness of liquidity. If you really think about it, that's what we're trying to measure here. How much money is it moving into how many stocks, right? And when investors are confident, that participation will naturally just broaden out. Buyers aren't picky, they just want exposure. And because breadth helps us evaluate trend health and sustainability, it also often provides early warnings, both when the market becomes vulnerable to deeper declines, so we're going to talk about that later, and conversely, when conditions are improving beneath the surface, setting the stage for big upside reversals. So what do we use here? What are some of the core indicators? Well, the New York Stock Exchange Advanced Decline Line is a core breadth indicator because it is just so simple, right? You've got a pretty diverse mix of stocks from a lot of different sectors and corners of the world, a lot of different market caps, and they track the advancing minus declining stocks cumulatively over time. So it's just a big addition problem if you think about it. And if we know the direction and the slope of that trend, we have an accurate view of stock market upside participation and therefore health. So when the advanced decline line rises, the trend is healthy. When the AD line falls, but price rises, it signals that you have a hidden vulnerability, right? That's what's referred to as divergence, because you have price going one way, right, in one direction, and then you have breadth moving in the opposite direction. So just a final note when it comes to breadth, and the reason why I make a really clear point to talk about New York Stock Exchange composite breadth, and you should never use NASDAQ composite breadth. It literally has a permanent downward bias. So if you try to look at it, or if you try to see people on X referring to NASDAQ breadth, it basically just fear mongering, because it's always going to have a negative bias. And it's really, because of that, not going to tell you anything very useful almost any of the time. All right, in the next section, we're going to focus on those divergences. While they're well known, you hear it a lot, especially technicians talk about divergences. And for most investors, even some technicians, they don't fully use them as the early warning signals for managing risk. In a sense, divergences are a lot like the yield curve inversions of the macro world. So most people recognize it's an important warning, but because it isn't a precise timing tool on its own, it often gets dismissed or pushed aside, or on the other hand, just totally overemphasized to the point where it sort of instills fear too early. But if used correctly, breadth divergences aren't about calling tops. They're about identifying the conditions for when risks are quietly rising under the surface. So let's talk a little bit more about those divergences. So when we talk about breadth divergences, what we're really talking about is a non-confirmation, right? That the market continues to push to new highs, but there are fewer and fewer stocks that are actually doing the same thing. So that those two things do not confirm each other. On the surface, of course, that means that everything looks pretty okay, but underneath that foundation, you have that weakening that's taken place. And that's why divergences matter, right? They matter if you're a portfolio manager. If you think about it, if you have a divergence in place, it would typically mean that you have a more difficult time finding stocks that are actually going up, because there are fewer stocks that are going up. In fact, the math of that simple AD line equation is that you need basically more than 50% of stocks going in one direction to move that line one way or the other. So when you have a divergence, you actually have more stocks going down than are going up. That's why that line is going down. So these tend to show up, these divergences tend to show up well before the price does. And like I said, they're not a precise timing tool, but if you use them as an early warning signal, as part of that just environmental change, then you know when you're vulnerable to disappointment or macro changes or news items or whatever it might be. And the way I like to interpret them is they're demonstrating that the market and the overall investor demeanor is becoming more selective. So therefore, my portfolio should reflect that demeanor change and also become more selective. What makes this especially important is how consistent the pattern has been over time. When you study the major peaks going back a century, which I have, almost all were preceded by some form of breadth divergence. Now, the specific indicators might differ, but the message is remarkably consistent. When the participation narrows for an extended period of time, the odds of instability or an increase in volatility go up dramatically. So again, breadth divergences are not about calling the absolute tops. They're about recognizing when the character of the market is changing and when risk management should begin to take priority. And this is a process that unfolds gradually. And I like to say that it's sort of like the changing of the seasons. Summer doesn't end all at once. The leaves will slowly fall from the trees, just as the stocks will quietly fall out of the bull market trend long before the index itself takes a turn. But beyond the advanced decline lines, we have other indicators, of course. There are other tools that are going to help you manage this process that you can attune to so that you're not just dependent on the AD line, which I said earlier, it's not a very good timing record. So that'll help us also understand how durable the trend really is. One of the more useful is looking at the percentages of stocks trading above key moving averages. And of course, the moving averages themselves are simple. They help define the trend. The 50-day captures sort of that shorter term momentum. The 200 reflects the longer term trend health. But instead of focusing on the index themselves, where the index is relative to those moving averages, this approach actually asks a broader and deeper question, which is how many stocks in a given universe or index are actually able to stay in those uptrends. And I like to use the New York Stock Exchange Composite again as the stock universe. Also the Russell 3000 I find is great because you get one of the broadest views and a way to look at this. And I think that's just really a smart way to look at these kind of numbers. So when healthy, you have a large percentage of these stocks are above their key moving averages. Now, as participation narrows, that percentage, of course, is going to fall, even while major market cap indexes are still pushing higher. You still have that same effect, that same illusion takes place here as well. Historically, one of the clearest signs of growing vulnerability, if you look at the later stages of these bull markets, these indicators will trade lower or trend lower for months, right? And fewer stocks continue to do heavy lifting. And of course, the advance will still continue, but with increasing fragility because there's less support underneath as conditions change. And if you think about that, it makes sense. The lower the numbers these go, the lower the probabilities as a portfolio manager of owning or identifying even stocks that are in uptrends, let alone stocks that are likely to outperform. So it really just makes the game a lot tougher. And this is a way of showing you, hey, the game's getting tougher, right? And if you use these indicators alongside other breadth measures, this gives you another lens into the market strength and where it's becoming more selective, and that risk really deserves more attention at that point. So up to this point, we focused on the market, what it's doing beneath the surface, how to measure that. And now in the next section, we're going to look at basically why so often investors struggle with it, where human behavior actually collides with these sort of mathematical realities of risk and drawdowns and compounding, and just more to the point of, hey, why are we doing this? Why the focus on breadth? Why the focus on avoiding the big drawdowns? So market breadth doesn't just reflect price action, of course, it reflects investor psychology, right? When that breadth is strong, it usually signals confidence. Investors are willing to take risks across many different stocks in different sectors, driven by optimism and often a real fear of missing out. And you can sort of remember this as recently as sort of the spring of 2021, which I remember quite vividly, where it was like the peak of the ARK days. People were really excited and they're willing to buy every little company out there, no matter how small they are or how little the prospects are for revenue. And it's that type of environment, which is again, it's a psychological condition. As cycles mature, though, that psychology begins to change. Investors become more selective, and there's still a desire to stay invested, but there's also this growing fear of loss, or at least a realization that attractive stocks are becoming harder and harder to find. So capital will naturally start concentrating into smaller groups of usually large stocks that feel safer, even if the participation underneath is still fading. And really, if you think about it, it's an emotional tension, right? You want the upside, but you're fearing the downside, and that creates this sort of paradox that we often see at major market tops. Prices are rising, but there are fewer stocks contributing, and that internal weakness starts to show up in the breadth divergence, of course. Now, in a sense, the breadth divergences aren't just technical signals, they're really a behavioral footprint, capturing that moment when enthusiasm and caution begin to coexist in the market. And because human psychology is remarkably consistent across market cycles, these patterns tend to repeat over and over and over through time. Now, when it comes to risk management and the idea of sort of like, buy and hold, one of the most common arguments against risk management is this idea that if you step aside, you'll miss the best days. And if you do that, then well, you're cooked. There's no way you can come back from it. Now, I know it sounds compelling and we've all seen the studies, but it really leaves out a lot of important details. I'll focus on a couple of them. The biggest one is, when do those best days actually occur? And you can tell by the way I'm talking, it's a bit of a pet peeve of mine, to the point where actually I co-authored a white paper on the topic a few months ago with 2 CFAs and CMTs to actually factually pick it apart. And I think we'll have a link to the paper at the end of this presentation as a resource. But one of the main points through that, historically, many of the strongest single-day gains don't happen in calm, healthy uptrends, right? They tend to show up as reflex rallies during periods of highly elevated volatility, often while the market is still below its longer-term trend, like the 200-day moving average. So in other words, the best days frequently cluster inside totally unstable environments that you do not want to be invested in, right around the very worst market days. And this creates a false choice, really. So the trade-off really isn't between capturing every best day and earning those long-term returns. It's between enduring those large drawdowns and preserving capital. So from a compounding perspective, avoiding the deep losses matters a lot more than participating in every sharp rebound. And I hope this chart really illustrates that point. You see the green far outperforms. That is using the same magical logic that we use for missing the 20 best days. What if you just missed the 20 worst? And the point is not to say that this is actually a realistic thing to do, right? Because that's just cherry picking, just like the original study is cherry picking. But if you theoretically could do it, it just demonstrates the point that it's actually a lot more important if you just avoid those worst days, right? So in this way, we're talking about disciplined risk management. It really isn't about perfect timing. It's about improving the odds by sidestepping what history tells us are the most dangerous periods, even if that means missing a handful of those volatile, huge upside days along the way, right? Now, even if you are a patient, long-term investor, you are hurt by significant drawdowns, and the math behind those losses really explains why, right? A decline doesn't just set you back in terms of the percentage lost. People think about it this way, but it actually creates a compounding problem. So a 10% loss requires an 11% gain. That's just to break even. Of course, that's manageable, not a big deal. But as those losses grow, the hurdle rises exponentially. So for example, a 50% drawdown, which you've seen historically several times through market history, requires 100% gain, so a double from the low. A 75% loss, which in single stocks you can get all the time, and we know that, and that demands a massive 300% return. So this asymmetry is one of investing's, I would say, harshest realities, right? It's just the math of it. The large drawdowns, they interrupt the compounding process, and they actually permanently reduce the capital that's available for future growth. And that's why systematic risk management matters. By reducing exposure to the conditions as they deteriorate, investors can preserve capital before those losses reach the extreme levels that are impossible to recover from. And this leads to, I think, a really important and overlooked principle that kind of goes back to our last slide, which is preventing the worst losses is far more important than chasing every possible gain. So letting a bear market run you over only to spend years digging out of that hole should not be considered sound long-term investment advice. And I don't know how many times I hear it all the time. Just hold the course, or whatever. It's not advice. A more logical and still very achievable objective is to proactively limit losses so that compounding can actually continue to work in your favor. Now, when we talk about volatility, some people, especially the younger of us, see it as something that doesn't really matter because they have so much time to ride things out. But when you see the mathematical effects, you're going to understand that volatility isn't just a temporary inconvenience, let's say. It's basically a silent tax on long-term returns, right? I think one of the biggest misconceptions out there in investing is that this idea that the market delivers a smooth, steady 9% return year after year. Of course, that's what that's the textbooks say, and it's totally unrealistic, right? That assumption might work in the textbook because you have to illustrate that point, but it doesn't remotely resemble how markets actually behave. What matters isn't just the average return; it's the actual path taken to get there, right? This is what we mean when we talk about path dependency or sequence of return risks. Two portfolios like we have here can post the same average 9% annual return, yet produce dramatically different outcomes depending on the order and the magnitude of those gains and losses along the way. So in this example, one series, you have that steady 9% that grows 137% over 10 years, just like the textbooks, and that's what the accountants say, that's what the textbooks say, great. Now the other also averages 9% per year, but with larger variability. And that ends up with only a 62% gain. So the difference isn't return, it's volatility. Once you include any negative numbers, right, like you see, everything changes, right? Even if you have huge big years, huge big up years, plus 50, I've got a plus 40 in here, a plus 45, a plus 35. Even if you have those big numbers in there, it cannot overcome those drawdowns, right? So that's why managing volatility, it's not about smoothing out the ride for comfort, for psychological comfort. It's about protecting the actual compounding engine, right? Controlling downside risk, improve the probability rather, that investors actually experience the long-term returns that they're promised on paper and in the textbooks, right? So far we've explored the behavioral and the mathematical realities that shape market risk. Now we're shifting from theory to application. So in this section, we're going to look at how market breadth can serve as what I like to say is a dimmer switch for exposure, highlighting historical warning signs and show concrete examples of confirmation, essentially turning these concepts into an actionable framework for navigating real markets. So since it's highly reliable but inherently imprecise as far as a short-term timing tool, I think of market breadth as, like I said earlier, a dimmer switch for equity exposure. It's not a simple binary on-off button. We're not trying to predict where the market's going to be next week or even next month. Instead, we're using systematic breadth measures to respond to what the market is already telling us through objective long-term evidence about participation and trend quality, right? In practice, exposure doesn't live in a fixed state, right? I think it's a continuum, and it should be a continuum, an adaptive framework, especially during periods of divergence. As that breadth begins to weaken or improve, the framework adjusts exposure incrementally, scaling risk up or down in proportion to strength of market breadth. That's obvious in the market, right? And that adaptability, of course, is intentional. And it's much more consistent with how market trends actually behave and evolve, right? You know, the pace of gains in one condition versus another condition are totally different depending on what's going on and where breadth is, right? So this more gradual approach, I think, also matters. And like we discussed earlier with the seasonal analogy, markets rarely flip from being super healthy to, you know, unhealthy overnight, right? The internal conditions, even into what you would call historically crashes, there's always warning signs ahead of time. So those internal conditions tend to deteriorate over long periods of time. And it's really about, okay, how do you examine the data to get that insight, right? And breadth, of course, is what helps us recognize those transitions early, allowing us to respond more thoughtfully rather than sort of reacting emotionally, right? And I think there's an important side effect from that discipline, and that's confidence, right? By removing emotion and replacing it with a repeatable, evidence-based process, investors can gain clarity about why exposure is being adjusted. And they aren't being just sort of driven or pushed around by headlines or fear or some sort of bias or conviction-based call. They're just grounded in observable market behavior that, you know, breadth, you really can't lie when it comes to breadth. It's just so simple, right? So the result is a framework designed to preserve capital as trends weaken, stay engaged as conditions improve, and give investors the confidence that risk is being managed with intention, guided only by the market's internal health. In other words, what the market is saying about itself, not any kind of forecasts or guesswork. So history offers some of the clearest lessons about market risk, you know, and it's been one of the more reliable signals if you look at breadth over time across cycles. Declining participation or breadth divergences has preceded about 90% of bear market peaks. And that goes back 100 years. And often you get those signals very early on, many months before the top. So we saw this during the dot-com bubble. By the time the S&P finally peaked in 2000, price had been diverging from the AD line for nearly 2 years, right? And that index kept hitting new highs and new highs, but fewer and fewer stocks were participating every single time. And that revealed this sort of, you know, internal stress long before what would be an eventual collapse and a long-term bear market, even into a secular bear market. And through a albeit shorter but similar pattern that emerged in 2007, 2008 financial crisis, while the divergences weren't as prolonged, the story was exactly the same. Market internals weakened even as price looked pretty resilient, and many investors had already begun adjusting exposure. And that's what that actually is telling you, that under the surface, people are adjusting exposure. Now, the chart I have up here that we're looking at, we see a comparable dynamic, just more recent, just to demonstrate the point that this doesn't change over time, right? Into early 2025, the S&P had climbed really smoothly and pretty well above its 200-day moving average for a long period of time. You see it's trending both ways. If I just showed you that top panel, right, and I just took that bottom panel away where we see the 80 line divergence, you would look at that and you say, that's a great uptrend. That's a strong uptrend. You're making new highs. You're making new, you know, higher highs. You're making higher lows. You're above the 200-day moving average. What do you want? You know, what more do you want from that? Now, meanwhile, you look at the bottom panel, the advanced decline line had begun diverging from those further gains in the index in late November 2024, so months ahead of time. And that's because fewer and fewer stocks were involved in that rally as it went on. And that is sort of, I think, the real point, is that breadth, it doesn't predict the top, but it shows you when the market character is changing. And that does one important thing. It allows investors the time to begin to think and to begin managing risk incrementally, adjusting that exposure gradually rather than overreacting or reacting after the price already confirms a deterioration. For example, if the index breaks its 200-day moving average, it's a really popular way to do things, then you take action. But the problem with that is you're acting at that point so late, because we know, like I said earlier, by the time you hit highs at a major market peak, 25% of stocks are already down 20% or more. So by the time the major index breaks its 200-day moving average, you've already had a lot of damage done under the surface, well beyond sort of protecting at that point. So it's sort of too late. So the final section here, we're talking about today's market. Now, how are we going to apply some of the framework that we went over to today's market picture and charts? So the first I want to show you, of course, it's really the same chart here. It's the S&P 500 on the top, and you've got the AD line on the bottom. And even in today's market, participation isn't moving in perfect lockstep with price, and that's important to understand, I think, in context, right? The common stocks only advanced decline line, which is the one we have shown on this chart, has not fully conformed the recent price highs, and it hasn't done that since late July, right? So that suggests that participation among typical or the average equity has been somewhat uneven beneath the surface, right? Now, that said, it's equally important to put this in perspective. This divergence is A, not especially deep in magnitude in terms of how many issues would need to go up to close this gap. And it also remains unconfirmed by a lot of the other breadth measures that we track. In other words, it's a signal worth monitoring, but not one that by itself implies elevated systemic risk. At the same time, other breadth indicators, like I said, look more constructive. If you look at the all issues advanced decline line, which includes the preferred stocks and the closed-end funds, that has confirmed the recent highs and even reached a new all-time high on December 11th, in line with the major indexes. So that suggests to me that liquidity remains broadly supportive of the market, because those interest rate sensitive instruments tend to be more, of course, liquidity sensitive, and liquidity has been what's driven the market for the better part of the last 20 years. So taken together, these signals point, I would say, to a nuanced picture. Participation is healthy in some areas while selective in others, and that's exactly where this type of analysis really adds favor, not by forcing binary decisions, but by giving investors the insight to adjust exposure gradually, find those sectors that are still working really well, because we know there are still plenty of them, and being really thoughtful and deliberate about where we are positioning ourselves. The other aspect here is uptrend participation, and this is showing clear signs of improvement. I think it's a lot more clear here than what we see in the prior chart. At this point, we've got nearly 70% of Russell 3000 stocks trading above their 20-day moving average, and that's of course a sharp increase from what we saw just in late November, when you had that number in the in the low 20s. It was 24% on November 20th. So that kind of move tells us that short-term momentum is broadening out, and that buying pressure is becoming more widespread across individual stocks. Again, this is a very good thing. Looking at the market through the longer-term lens, roughly 60% of stocks are currently above their 200-day moving averages. Now, just for context here, in strong, mature bull markets, this measure will typically go above 70%, even into the 80 percentage points, and often peaks, again, like a divergence, months before major market highs. So from that perspective, participation has improved, I would say, meaningfully, but there is room for further expansion, which is a good thing. It's a glass half full type situation. And if the advance is going to be durable, this number going into the 70s would be a really positive sign to see. And I would also add that there's a really big difference here between achieving a 60% in this number while in sort of repair mode, as we have been since April, and having that same 60 in sort of a decline mode, like we were from the peak in November of 2024, before that major market top in February, right? So just having the same number, approaching it from a different angle, again, it's just more context. But I think what's really important here is that the improvement is coming from the smaller cap stocks, because this is on the Russell 3000, which tend to be more sensitive to shifts in risk appetite. And that, to me, suggests that internal conditions are actually repairing rather than simply being propped up by the narrow group of large cap names. That's not what's going on here. This is broad based. That's a good thing. So overall, the message from the internals is constructive, but I would say not totally conclusive in terms of to be sort of really aggressive here. But certainly from a cyclical standpoint, it looks like cyclical bull market, still intact here. And the recent improvement is definitely encouraging. We'd of course like to see more follow through, especially from the smaller cap stocks, and you get some of those numbers above some of those thresholds that we talked about. So I just want to wrap this up with some key takeaways, right? I think the first thing to remember is that price alone doesn't tell the full story, right? Major indexes can appear strong even when participation underneath is limited. So breadth is a crucial lens for understanding true market health, right? The second is that defense drives outcomes. We've heard that in sports. Defense wins championships. Well, avoiding large losses prevents capital from avoiding those large losses preserves capital and compounds far more effectively over time than actually chasing those big upside moves. And then finally, I would say that discipline beats emotion. Just really simple, right? Systematic, rules-based decisions consistently outperform gut instincts unless you're sort of a 1 in a billion type trader, particularly during those periods of heightened volatility. This just allows investors to stay invested when the trends are favorable and of course play defense and protect themselves when the risks are rising or when they need to be defensive. So that about wraps up the conversation in terms of my prepared commentary. Thanks, of course, for your time and your attention. I'd love to hear your questions and discuss any concepts you covered today. If you want a deeper dive, I made some resources available on this last slide. Of course, you can visit our website, viewright.ai. You can connect with me on LinkedIn, Vincent Randazzo, CMT, and on X, I am CMT Randazzo. I'd encourage you to explore some of these the white papers, articles, videos. I've again included the links there. But with that, let's open it up to see what questions you have, and I'll turn it over to Andrew.
Brilliant, very insightful. Thank you very much, Vince.
My pleasure.
Patrick says that was fantastic. Thank you. Let's see. Theodore says, is it true that Dr. Martin Zweig invented a classic market top indicator called the market breadth thrust indicator? And how reliable is it? What are your thoughts on the market breadth thrust indicator?
So the breadth thrust indicator is actually for identifying major market bottoms, and it's actually quite a reliable tool. Certainly post-war, post-World War II, it's been very reliable. So I would say yes, that's something that is quite reliable. In fact, perhaps he's bringing up the point because we did get a trigger of a Zweig breadth thrust earlier this year after the bottom in April. So historically, quite good forward return profile with sort of a minimal drawdown profile historically. And I think if you apply it, if you look at the back test though, pre-World War II, you're going to see some big misfires though at different times. But that's what I would say about Zweig. Yeah, very useful.
I have the same question Fabrice does. Why is the NASDAQ advanced decline line negatively biased? You never explained why. Yeah,
I'm glad you asked the question. So in fact, I used to work with the NASDAQ, so I'm not trying to throw shade or anything. I really loved it there, and a lot of great companies are listed there. Of course, some of the best companies in the world right now and most innovative companies in the world right now are listed there. But historically, what you'd seen was a lower threshold for listing requirements, which usually meant that you got lower quality companies that listed on NASDAQ, which meant that a lot of those companies would sort of list and then sort of go into death spirals. You could think of literally hundreds of SPACs just off the top of your head, maybe, or biotechs that have this negative bias. They're just in death spirals. Almost as soon as they list, they just sort of go into sort of a death spiral type mode. And that's actually quite common on the NASDAQ, and that's the reason why.
All right. I am looking in the studies on the on Trader Workstation here for the New York Advanced Decliner, NYSE Advanced Decliner. I'm not seeing it. Maybe I'm just not looking in the right place. If somebody wants to shoot me an email at webinars@interactivebrokers.com, I will try and find that on the platform. Otherwise, let's get back to the questions here. Let me throw one of these questions in. If there's one mistake that investors tend to make during the late cycle or in a volatile market, what is it? And how can a rules-based framework help avoid it?
Yeah, that's a really thoughtful question. I mean, I think the most common mistake, there's probably two, but so I'll kind of go through that, would be relying on emotion, and because they're both emotional here. When those conditions become uncertain, either it's sort of being overly exposed because the prices are still rising, and sort of wanting to squeeze the last bit of juice out of that bull market. I think that's sort of a tendency, or actually exiting too quickly because volatility sort of forces your hand, and usually it happens toward a low when the second one takes place. Now, the problem with emotionality driven exits is that they're rarely temporary, right? Once investors decide to step aside, especially when they're under stress, it becomes psychologically difficult to re-enter. And I've seen this so many times, even when it comes to professional money managers that I've worked with. And even when conditions improve, the fear and the second guessing really will delay action, and that causes investors to miss the recovery. And then they're trying to protect themselves. They were trying to protect themselves in the first place, but now they're hurting themselves because they're sort of applying that framework too long. So, rules-based framework would help avoid this because it really forces that discipline, right? You avoid that trap by removing the need for binary sort of all or nothing decisions. And instead of, let's say, predicting tops or bottoms, you're just really adjusting your exposure gradually as the market conditions evolve, and they just tell you more, and then you just sort of react to that and not the emotions that sort of wag that dog, right? So so that's where, again, breadth is especially valuable. It can provide really that objective feedback of trend quality that you need.
Can you go back to slide 21? That's an observation I had, really. Just move the chat panel out of the way. Yeah, so on the advanced decline here, if the market does another 5 to 10% on the upside, my assumption, looking at the advanced decline line, is that it would break the red trend line to the upside. Is it then, from your perspective, all bets are off? The advanced decline line now supports the current advance.
Yeah, and that's why I said it's important to understand the magnitude of the divergence that you're talking about. As you pointed out, it's not a huge magnitude of divergence. We're only talking about really a couple thousand issues shy of a new high. And what would that mean? So if you think about, a really strong up day, you can get 1,000 advancers, no problem. So if you had, let's say, 2 or 3 strong up days, then you can easily take that out. Which is why the other 80 line is also important to look at. The all issues 80 line, which already made a new high about 5 days ago, is already telling you that, okay, that's the direction it's probably going to go. So if anything, I would say that that one is sort of been in a leadership position versus this 80 line, which is the common stocks only version. So I think you sort of defer to the 80 line that is in a leadership position that has been, over the last 20 years, a little bit more accurate at sort of spotting turnarounds and one to watch. Yeah.
Brilliant. Vince Randazzo, CMT, thank you very much for joining us today. Vince is with ViewRight Advisors, and we look forward to speaking to him again in January, hopefully.
Sounds great. Thanks for having me, Andrew. I appreciate you all and your attention.
Thanks. Thank you for taking the time, Vince, and thanks to the audience too for joining me today. It's been a real eye opener. I really appreciate this presentation. Don't forget, we'll be available later today at the Interactive Brokers websites. Look under previously recorded webinars. Look out for the email in your inbox. That will be coming to you too. Thanks, everybody. Bye for now.
Thanks.